an underwriting. There's a underwriting requirement that happens 620 and below, but is it filming already?
Mm-hmm.
Yeah, we're filming.
So, self-employed person with a 1 year of experience, can you get a loan?
Yeah.
How?
Okay. Prior experience.
Prior experience?
Yeah. So I was doing one for a client of mine, I won't name, but she had her own business, was a hair salon. I'd been dealing with her and got it pre-approved and was working on that, and all of a sudden she went quiet. She wasn't answering my calls anymore. I was getting ghosted, and I reached out to the realtor, and the realtor was like, oh yeah, the story there was her husband's fiance at that stage, but her fiance's family friend was someone I won't name, but very experienced. Apparently, I didn't know who he was, but broker owner, loan originator, and he had gone to her and said, no, you can't purchase a home when you've only got 1 year of taxes and you're in your first year of business. So not true. So I reached out to her and said, you can actually. Her background was she'd been a hairdresser in the past. Her mum had sold her the salon. She had taken over the business. We were able to show that her past experience, plus her 1 year as a salon owner, was enough to qualify her for a mortgage. So she bought and also got a great rate. It was also that was a conventional loan. But yeah, she bought her. Taxes. The other thing that happened was kind of interesting on this one was we were right about the time of taxes. So we had her filing her taxes, and you have to be careful, because I can help people along, but we have to watch for guide, as far as guidance goes. And her accountant was basically wanting to put through every deduction under the sun to have her paying as little tax as possible, but of course that means you have no income. So we were able to speak to the accountant on this and say make sure you're keeping her income accurate so that she qualifies for her loan, and was able to do that. So there's a lot we see. I deal a lot with turn downs. I deal with a lot with loans where people get told that they can't get approved, and it's because they're getting the wrong advice out there.
Or the broker they're talking to doesn't have the product. You go to Chase, and they just don't have all the products that are available to a broker like you.
Well, I appreciate that push and that, but it's true. I mean, with a lender or a bank or a rate sheet, they typically can't do it all. Now, I'm saying that if you're going to Chase and you earn $10 million a year, they can do whatever they want for you. They're going to probably, you call them up, you've already got however much in loans with them, your income's massive, you've got huge savings and checking accounts with them, and you say you want to buy a holiday home. I'm probably not going to see that client, because that bank can pretty much do whatever they want for them. But for most of us out there who aren't doing lunches with the president of the bank, it's a different case. The reason people use brokers is, we will beat banks on rates typically.
Let's talk about a situation where somebody wants to buy a house, they've got pretty good income, their credit's good enough, but they've got no money to put down. What are some ways that person can get into a house?
Okay, so they've got no cash to put down.
I'm just thinking about a deal we did where the guy walks into the closing table with nothing, and he walks out with keys and $5,000.
All right. Well, you can. One, if you're a veteran, this is the thing too. We were talking earlier about the, minimum credit scores and things like that. We can get veterans approved down to a 500 credit score. That's where I see a lot of business coming from. New communities out there. People go to builders, they get offered all these incentives. It makes a lot of sense, beautiful new home, but they're not very good at getting complicated loans done. So veterans can get approved up to 500 with a 500 credit score and above. The other thing for veterans is you can't get money back except for the earnest money you put down. So that was his earnest money and his deposit coming back. So he got in for 0, got cash back. He and his wife got money back at the table, and I have that with multiples of my veterans. Pretty much my goal when I'm working with a veteran is that not only are you going to put no money down, but you'll get money back at closing, and that's what you're allowed back there. Then you did your bit on that bit, Mike, which was negotiated every freaking seller's credit under the sun. So they had no closing costs whatsoever. Now you can use, when you're buying a home, you can use seller's credits for closing costs, but you can't use them for down payment. With a veteran, they can have 0% down payment. You negotiated enough seller's credits to cover all his closing costs, and they got cash back at close.
That was a deal.
We can also do, FHA 3.5% down if you have money in your 401k. You might not have money in the bank, but you've got money in your 401k. We can use that for your down payment, so now you're getting in without. You might think you have no assets.
Loans against your 401k are non-reportable.
But a loan against your 401k, I mean, there's a difference between not reportable and what's ethically and morally right. But if you take a loan from your 401k, typically that payment's going to show up on your bank statement, and the underwriter's going to ask about that. But just report it. I mean, I've got a client that just borrowed $4,500 from their 401k. It's $30 a month. They use that for their earnest money and their down payment. Now, some people can take money straight out of their 401k and not have to borrow it. Other ones, you do it as a loan, but it's a $30 payment. It made very little difference to their debt to income. The main thing I think on that, the biggest thing I say to realtors out there is don't disqualify your client. Don't tell them that they can't get a loan because of this. Make sure you got somebody good up your sleeve to send them to, who can go through that first with them and check if they qualify. I mean, the amount of people I've talked to too who is like, we can get you in for $250,000 house, It might not be the biggest house in the world, but it's a new home for that family. It's super important. 3.5% down, you're at about $8,300. Don't fact check me, but 3% down on 250, you're at 7.5 plus another 12, so you're at 87, around about $8,700. If you've got 8,700 in your 401k, now you can own a home. If you have $5,000, but a family member can gift you $3,500, you can now buy a home. So using gift funds is good as well. And then we'll organize sellers credits to cover the rest of the costs typically.
What happens? So the funny thing about seller's credits is you got to make sure when you're adding them on, you got to make sure that the house is going to appraise, for the extra money that you're tacking on to give back to the buyer. I've never been in a situation where the house didn't appraise. Have you? Or didn't?
I'm smirking there because, again, you want to have the right person on the right side of the table. You don't want a Mike or a good experienced realtor on the other side of the table and an amateur realtor on one side of the table. And if you've got a proactive broker, I don't want to sound funny there, but I call underwriters, I call listing agents, I support my clients' offers. If, Mike's putting in an offer, multiple offer situation, I'll call up the listing agent. I just had it with another client of mine. The client was putting an offer, it was FHA. The realtor still had this outdated view of FHA loans and said, I don't know if I want to take an FHA loan. Also, I'm not sure if the property will appraise FHA. I mean, I could do a whole video on that. There's a difference between conventional appraisals and FHA appraisals. Typically, the difference isn't huge. I'll give the game away, If it's not going to appraise FHA, there's a good chance it won't appraise conventional either. But there is some areas and you need to know about it. But anyway, so I called up this realtor and I said, look, this client's a great client. It's an FHA loan. It's an FHA loan for this reason. And the property looks great. I've checked out. I hear the issues you've got. I've verified what those issues are. I don't see any reason it won't appraise FHA. And what I'll do is I'll order the appraisal at the same time we make the submission. So you're going to have the appraisal back within 8 days. And the appraisal, if it doesn't appraise, you've now got time to get out of it while everyone's in their option period, and you can move on to another buyer if you want. But I'm pretty sure that won't happen. And that's what happened. We got the appraisal back. It appraised fine. It's all good. your original question there was about
So let's put this
FHA.
scenario. This house is $140,000. It's a great price for the house, but it needs an air conditioner. So we negotiate. We'll pay $150, but you're going to give us 10 back and seller's credit, so we can buy a new air conditioner.
Yeah, so you were talking. Sorry, yeah, you were talking about does it ever not appraise?
Yeah, so
I was
then-
saying,
so then the
right,
appraisal
we've
comes
got-
and it's
we had
145.
15K in sellers credits on this one.
Mhm.
The short answer on that is, yeah, it's got to appraise, including the sellers.
But what happens if it doesn't?
Yeah, and if it doesn't, if it's for a VA loan, it's called a Tidewater. Means it hasn't appraised. You're going to get notified about 24 hours, 48 hours before the appraisal comes out by the appraiser, and he's generally going to reach out to me and the listing agent, and he's going to say, hey, I've done the appraisal on this. It doesn't look like it's going to appraise, and they give you an opportunity to submit comps. Now, I've been in that situation where I've written letters, submitted the comps, and we've got the appraisal up. I've been in that situation where we've submitted letters, we've submitted comps, we've had specialists on the phone, and we haven't been able to get the appraisal up. And what happens then is that the clients come back together and they re-meet in the middle, or the buyer is no longer obligated to purchase because their mortgage won't be approved, so they're able to exit the purchase without risking their money. But that's not a great result for the seller. So that's why a listing agent who's looking out for their clients is usually going to be pretty careful that the seller's credits are going to fit in there. But as you say, never been an issue with us.
Can the
And
buyer?
we've done 6% seller's credits. We've done 5.
Yeah.
We've done 6, and we did. A lot of people don't know with the VA you can actually go 4% in seller's credits plus other costs, which can take it right up. So knowing how to get all those things, the goal should always be, I'm going to get the best result for my client.
Can the buyer insist, hold the seller to the contract? Hey, you said you were going to give me these seller's credits. You're going to have to take it out of your own pocket.
No, because you were also agreeing to, the purchaser was also agreeing to a specific purchase price that was based on the appraisal. So you can't make them. Typically what happens, short answer on that, is usually the buyer is not going to be able to come up with more funds, and the seller is going to be the one who has to reduce the purchase price to make it work. You're usually talking about, when I've seen it happen, the appraisals we'll approve 3% of the seller's credits, we're not approving 6, so that there's a difference of $9,000. Maybe this buyer brings another 4.5 to close, the seller brings another 4.5 to close. Sometimes even the realtor will discount their commission by 1%, but it's not something we like to start with.
But it's there.
But it's there.
And I use it.
And the buyers, I've seen it when the buyer's agent and the seller's agent both negotiate, they just drop their commission a little bit because they wanted to make sure that their client got it across the line. But these are things you usually check out up front, And if you're working with experienced people, you kind of know how much you're going to get away with as far as seller's credits go.
Interesting.
Love the question.
What else? What's the FHA loan where they give you the money for to do the repairs?
Oh, 203K loan?
Yeah.
How are we going to do these videos? It's just going to be, it'll be kind of cool, I think, because it'll just be like you starting at a question and boom, straight in, because we'll do short ones. But 203K loan,
Yeah.
they will loan you the end value of the home. So say you see a house, you like it, it needs a bunch of work done on it, and it's going to be worth $350 when it's finished, and at the moment it's on the market for $260 because it needs those repairs. You can go out, and it's an FHA-backed loan, so you only need to put 3.5% down. They will loan you up to 96.5% of the end value, so borrowing against the $350 end value. But there's some caveats with that. There's some things you have to watch out for. Like, one, they're going to want to vet the builder to do the repairs.
Is the 3.5% against the 260 or the end value?
The end value.
Okay.
Yeah. But they're also loaning you the end value. So, if you're borrowing, what's 96.5 times 350 is about 332, 334. So they're going to loan you 334,000. You've now bought a $260,000 house. You've got $70,000 left over to pay for repairs. 260, yeah, about $70,000 left over to pay for the repairs. And yeah, but the caveats on that are if you need a fast close, it's probably not going to work, because you have to go and get the quotes for the repairs. Those quotes then need to be checked off by the lender. They also have a secondary inspector, I forget the name, but it's a HUD inspector for housing and urban development to check that those repairs are going to be done correctly. And the secret on that one is have a builder who's done it before, who's been approved, or have a broker who's done a lot of them before, and they have those builders up their sleeve. I know builders who have already been approved, so when you come to me, I'm just going to line you up with the builder and get that stuff taken care of, and then set realistic expectations with the seller. It's a good one if a property's been on the house, a house has been on the market for a while, and it's a good one for listing agents to think about as well.
When was the
And
last
if a house has got lots of stuff to fix up, it probably has been on the market a minute, so it saves you from having to take cash offers.
When was the last time you've done one?
Oh, not since last year. Not since last year.
I get the idea that people forget about it.
And you learn a lot on each one, and I ended up with the database of contractors off the last one, which is gold.
Yeah.
Can't have it.
Yeah, this one I've ended up with contractors and a lot of investors that I have good relationships with now.
Yeah. No, it's good. It's a good known, the more products out there. I mean, bank statement loans, self-employed borrowers out there, do a little intro in case we turn into a video, but hey Mike, do you deal with self-employed buyers very often, or,
Yes.
do you want to know about some products that are good for self-employed borrowers?
I do want to hear about products that are good for self-employed.
That's convenient, because we happen to be filming it right now. But, there's a lot of people who earn really great money out there, and I'm not going to get into the depths of it, but maybe their income doesn't reflect that. By the time the accounting, by the time the business expenses come out, and all the rest of it, maybe they're not showing as much income as they need to purchase a home that's actually affordable for them. So having alternative products is really important. Remember, a lender's just worried about the risk. They just want to know that their money's safe. I love it. I mean, there's people who go do cash buys out there, and I'm like, one of the things I love about working with a lender is they're going to vet it, they're going to check it, they're going to check that your pricing's right. You go do a cash purchase, don't get me wrong, people who know what they're doing out there, it's great, but you haven't been through the vetting process, so the lender's going to check that it all makes sense. They just want to know that their money's protected. So for self-employed people out there, I've done bank statement loans. So you get somebody who maybe their business has $8,000 a month coming in payments, but they can't show that on their income. It doesn't come up on their income. You can get approved using what's called a bank statement loan. They just look at those numbers, and if that services the loan, then that works. There's some more details to it, but it's kind of boring to put in a video. Main thing is to know that it's out there. The other one's called a DSCR loan, super popular, especially for people who have bought a couple of investment properties. Like one of my clients who does a lot of deals with me, he's got great income, he's an IT engineer, but he's now got a whole bunch of properties, and it really starts to get complicated to provide homeowners insurance, property taxes, and income details, and all of this stuff for multiple properties, and to get it approved. So they have a loan called a DSCR. It's a debt service coverage ratio loan, and it means that you get approved for the loan based on your credit score and the fact that the rent is going to cover either a portion or all of the housing expenses.
I thought it had to cover all of it. It can cover just a portion.
Oh, did you? There's a lot of people out there who think that it has to cover all of it. But there's actually products out there where, where it doesn't. Where there's actually products out there with no minimum DSCR coverage. The rate's going to be higher, but it could cover a portion of it. It might only cover 50% of it. I've never seen, I'll be hands on, I've never worked on one where we didn't cover at least 50% of it. And not many people are going to buy a property that doesn't cover at least 50% of the mortgage.
Are you talking when the higher interest rate, is it a percent, more than a percent?
It's probably like 1%. I mean, all these things vary, but
that's a lot.
depend. It's not that much. It's a percent if you're buying something and it makes a lot of sense and you're buying it as an investment. I mean, residential properties in Texas, they double every 12 years. That's a stat you can take to the bank. Buy a property now. I've got a client of mine, she's got trust fund, she's wondering what to do with her money. I said the simplest thing, go buy a house, buy it for $400,000 today. It's pretty safe to say that 10 years from now, it's going to be worth $400,000 more. 10 to 12 years, it doubles. That's maths you can take to the bank. In that time, you'll also be collecting rent. You'll also be able to depreciate that property on your taxes. I mean, property is the number one way to make money in the US. I'm not talking about IT and all that sort of engineering stuff, but nothing has the amount of, to my understanding, and feel free to jump in and tell me how wrong I am, but to my understanding, there's nothing else that has as many tax advantages as property, because the government back in the day decided it would help with health, it would help with roads, it would help with schooling. But they weren't initially, maybe now, but they weren't helping with homes. So they created huge tax incentives to encourage developers to go out there and build homes. And there's still a lot of those incentives in place. So the fact that you can buy a property and you can depreciate it on your taxes every year, like even though the house has gone up, you get to go through it and say, well, all the pipes are older, all the taps are older, all the door handles are older. I get to depreciate all of that and claim that back on my taxes. That's a huge advantage.
Would you do in a rental?
On a rental?
Is that what you're talking about?
Yeah, you can depreciate on a rental.
It's called a cost, they do a thing called a cost segregation, where you can, rather than use 37 years to depreciate it, with this cost seg, you can depreciate it all in a couple of years. And it's a massive short-term savings.
Huge. Yeah.
Huge.
So all sorts of advantages like that and getting that kind of advice along the way. So where we're going back to, talking about, the rate being higher, maybe it's going to cost you 1% more, but it's the difference between not buying it and buying it. It's the difference between, and it also might make you stop and think and go, wait a sec, this rent is only covering 50, 60, 70% of it. Now I can either put down more money, reduce the loan amount, now it covers it. I can buy the rate down, now it covers it. I can look at like the one we were talking about. You can just look at the property taxes are actually lower than what we thought, or I thought, and the insurance, we can get that down a little bit. Now it covers itself 100%. So digging into it, but also if it doesn't cover it at all, maybe it's not a good investment. Maybe that's your little warning to go and look at another one. I mean, buying property shouldn't be emotional, even with a personal primary residence. It should come into it. But any first-time home buyer out there, I want them to get a good home for their family, but I also want them to make money. I want them to go step out of it 4 years down the track. They've made 60, 70, 80, $100,000 on it, and they go trade out of that one and they buy into a bigger home. That's the American dream. So my old man used to always say, you make your money when you buy, not when you sell.
Always in the buy. Money's in the buy.
Time out on that one.
There was something else. There was another topic that just understanding how taxes work. Like Texas is considered a non-disclosure state, and I'm not sure, but I think one of the people that don't get the disclosure is the tax office. When if you buy a house, if you pay over for the house, are the taxes necessarily going to go up by that much the following year? Do you understand that?
Oh, on the property taxes, like when you purchase the home?
Yeah.
No, and it's not. I be honest, this would be something good to research further, but I know people who bought in, and I'm sorry to put it out there, but some of those, the new communities they bought last year, and the value of the home's gone down since they bought it, because a big new community's just been built right next door to it, and they're offering incentives when you buy, so you're trying to sell that house, you've got no incentives to offer. That could be a whole other video. Don't get me wrong, new communities are a great way to get on the property ladder and stuff. You just have to be aware of it. So anyway, you know, I've seen people say their property values go down the next year, and then their property taxes reduce because of that. But yeah, just putting in an offer on a home, and then the house selling for that doesn't necessarily become the taxable value the next year. There is an appraisal system, and you know, that's what works that out. But that's a little bit outside my field.
I want to figure out how the whole appraisal system works, because sometimes you go and look and it's like, why? Like for instance, this house that I have listed right now, the acre that it's sitting on is valued at $200,000. A mile down the road, my acre is $300,000. Why is that?
A mile down the road, your house is sitting on a land, and your land's valued at 200.
Mine's 300, but this one I'm trying to sell is valued at 200.
Same amount of land.
Exactly. Actually, the one that's 200 is a tenth of an acre more. It's 1.01, and mine's 0.93 or
Are
something.
you on an acre?
Yeah.
You there's houses. You're in the suburbs, and you got deer frolicking, and you know, freaking dolphins jumping out of the river behind it. It might not be dolphins, but you know, it's a heck of a house, and I love that around Austin. I love the way we have these, you know, some of these suburbs back. I back onto a pretty green belt. I love coming out, and there's a stag lost in the suburbs, but you know,
Right.
at your place, they're kind of at home there. They don't have to
The guys
quickly find themselves back to the bush.
My neighbors had a corn feeder out for 20 years. I mean, it's dinner time. They come running up.
Yeah, no, it's beautiful. I love Shady Hollow.
Shady Hollow.
Come to the neighborhood.
Come to the hood.
Yeah, it's good. You want to drop your kids over in golf buggies. You know, let's talk about Shady Hollow a little bit. Can you tell me about Shady Hollow, Mike? Because you are involved in a few things in the neighborhood. I met you through Jacob Youngblood over at Youngblood Real Estate. And
I met you.
I met Jacob through the ATX mini bike cruise. If you've been over, you know, through Shady Hollow and see a bunch of adults cruising around on kids' bikes that go like 80, 90 mile an hour, that's us. It's Texas stupid. It's so much fun. I met one of the guys, Steve, the mayor in Hosa, at one of the community events, and he was standing by this motorbike. I'm like, dude, is that one of those razors? I want to get one for my kid. Is that your kid's bike? I want to get one for my kid. And he's like, no, it's my bike. I'm like, all right, I'll try not to judge. And then he's like, no, it goes like 70 mile an hour. I've got this on it. There. He starts showing me, and it's awesome. Of course, a month later, I had my bike. My kid had a bike, but technically I may have bought it for me and him, and he hates me because it spends more time being fixed up than I'm riding it. But and then I met Jacob, who's awesome, a great resource in the community, and he introduced me to you. And I ran into you at Bailey.
That's where we
doing
met.
Plants and Animals. Or
That's where we met. And I spotted you from 50 feet away and knew I got to know this guy. That's before I knew you were a lender. I just knew I got to know that guy. We were up at, I was doing some gardening stuff that I'm not doing much anymore. At some point I decided I've just got to focus on one thing.
Yeah.
And real estate. And cars.
and cars.
And cars.
And family.
Yeah, right.
And he still does a bit with that stuff, but I mean, yeah, I mean, can we just drop that in there a little bit just in case our 12 followers want to, like, you know, that's the Native Plants and Animals initiative at Bailey.
So now it's 12 years ago. 12 years ago, three Shady Hollow women had come up with a plan for this quarter-acre courtyard at Bailey, and they had like a $60,000 plan, and they'd raised $8,500. And they asked me if I would execute on it, and so I started going to the PTA meetings and realizing that everybody had their eye on that money, and that I needed to spend it, otherwise it was going to get gone. So the first thing I did was bring in a dozer and do the dirt work, level it out, fill it in with crushed granite, and maybe that took up the $8,500. Then I got another grant for like $3,000 and did some irrigation, but then I won a $10,000 grant, and with that I put in the greenhouse and still had thousands left over. And I worked on that project up until COVID. The day that COVID, March 20th, I think 2020, when we shut down for COVID, I had chickens in my arms that I was delivering to the chicken coop that I just had built, and it was like, school's over, and they're not coming to school anymore. And thankfully, some guy, I can't think of his name, but another dad said, I'll take care of the birds, and he took care of those birds every day for 3 years. At any rate, it's still there.
No, I mean, I love. We were going up to Bailey with my kids when they were, younger, before they were at Bailey, and just, we were able to. Somebody came out. It wasn't you? Let us go into the chicken coop, play with them. My kids are now both in Miss Tafoya's class, or one of them's active in it, and they've also got the radio station, Monarch Radio at 87.5 or 87.6 or something. Monarch Radio is really fun to listen to, and the kids do that.
The kids love making the radio ads and doing they'll record all the music and then it's just playing.
But they always can do with more money and support. So if anyone wants to help out with that, no, but that was an awesome effort on your part, and I got to go out there one of the days when the journalist was there, and we should have been doing content, but the journalist came out and was doing an article on y'all, and it was really cool. And I think I moved 12 plants in the heat and felt like I'd made a contribution because it's hot here.
Yeah, right.